At the end of 2024, I was at the NASDAQ closing bell ceremony and I did an interview. And in that interview, I made some forecasts for this year. Just listen to this quick clip here of that interview.
As far as gold goes, it is an interesting time because gold has been going up with a rising dollar as well. And I think if you know where the dollar is going to go, I think you're going to determine where a lot of various markets are going to go. And thinking about the dollar right now, with Trump being elected, typically we have poor seasonality in the dollar coming into the end of the year. However, with Trump in 2016 going into the end of the year, the dollar rallied. And it wasn't until 2025 started where we started to begin to see falls in the dollar, which helped emerging markets, helped China right out of the gate. And if the dollar does continue to fall, I think that could be pretty positive for gold.
All right, everybody, welcome back to the show. So this is the chart of the dollar that I was discussing in that video. I mentioned that it's typically poor seasonality at the end of the year for the dollar, but given the fact that Trump was elected, we started to see the dollar rally higher into the end of 2016, going into his first term, 2017. And from that point, I called out that year we saw a very weak dollar. And if we were to see the same thing, we would see a very strong year. It would be very beneficial for gold, as you can see, it has been, and then also emerging markets such as China. Now, during the 2017 year, I wanted to pull up a chart of, you can see kind of there was ebbs and flows, like points of pivot points, right, into January 31st or towards the end of that month. And then we started ripping up higher. Then we came down, made a new low. Then we bounced higher and so forth. And I started to track these pivot points throughout this year to help really kind of navigate potential markets. And you can see here during the end of January, we saw a bump higher, then it faded to a new low. Even right there in March, we saw a rally before it headed higher. And what I find so interesting now is if you just look at this chart, the dollar, what were we doing here in September? We were finding a potential bottom. What are we doing right now? Are we finding a potential bottom? Well, what happened in September around this same period during the first term of Trump being in office? And you can see here it is, September, we found ourselves a bottom early on, and we ended up actually rallying for a few months with the dollar. And if you pair this with seasonality across the board, right, just looking back about 20 years, not just Trump's presidency, towards the middle of September, you actually get positive seasonality. So not only from just the perspective of him being back in office, but also if you look at a 20-year time frame, this is typically the area where the dollar can see some strong seasonality. Now, what does that mean for us traders and us investors, right? Well, prior heading into 2025, it told us, hey, maybe we should start looking at gold, maybe we should look at emerging markets, all of which happen to do good. But now we need to take a little bit more of an approach by looking at, okay, well, how is the dollar correlated currently to other assets, right? If we take a look at the dollar right here, this is the dollar up and away as I'm moving my chart around, tick-tock, here we go. It's the dollar up here, and this is the correlation. They're all 20-day correlations, okay? So I'm looking at 1, 2, 3, 4, 5, 6 correlations. So this is the S&P 500 right here. What do you notice? It's at minus 0.65. I know it's hard to see, so that's a negative correlation, meaning from a 20-day perspective that if the dollar goes higher, this shorter term time frame is just telling us that we can see weakness in the S&P 500. The NASDAQ's at minus 5.1. The IWM is at minus 0.53. So all negative correlations to the dollar, which means what? It means that as this has been falling, it's been quite positive for the markets. That's nothing new. We know that. Same with emerging markets. That's actually 0.73 negative correlation. So if the dollar starts moving, we might even see more weakness there in the emerging market, or this is EEM that I'm using as the proxy. Bitcoin, there really is no correlation right now from a 20-day period. And then gold has a little bit of a negative correlation at minus 0.38. So in short, if seasonality holds true to what happened the last 20 years or just in the first term in 2017 for Trump, and we start to see a dollar move from this area, that could put a potential pull a pin of this current consolidation that we've been seeing in markets. But there's a little bit more to this. Right? It's not just the dollar that matters. We also have to look at rates because there's a lot of talk about rates, and we're seeing a big move these last 3 or 4 days in rates. So the question would be kind of, well, what happened to rates back then too? Well, first let's look at the correlations. And look at this correlation here, minus 0.61 correlation from a 20-day perspective on the S&P 500. So once again, falling yields, falling dollar have been quite positive for the markets. NASDAQ 100 minus 2.8, IWM minus 0.73. That's a pretty deep negative correlation. And then you have emerging markets minus 0.55, minus 0.36 for Bitcoin. So not much there too. Bitcoin, the correlation from a 20-day perspective, there's not much going on. And then we have gold. Look at gold's correlation right now from a 20-day perspective, minus 0.86. Wow, that's a very strong negative correlation. And we've seen a big move down here in the 10-year yield. And what have we been seeing gold do the last 4 trading days? Boing, 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 right up. In fact, actually, it's kind of cool. Take a look here. We've seen a couple of these symmetrical patterns, and when they break out, you get these really kind of frothy RSI ratings. So we're right now at 79.34. This is the highest level we've seen since, well, basically this high where we saw a little bit of a consolidation, and then going into a larger term consolidation. Prior to that, we broke out of a pennant compression pattern. We moved higher, we got extended, and then we consolidated. Same over here. We moved higher, we consolidated, got that. That was even higher than 79. And then over here, same thing. We went back up, pretty extended, right in I marked that poorly, but right in this area. And then we consolidated within this area right over there. You can really see this, right? We've been sharing this chart, a falling dollar, falling yield. It's been really beneficial for the S&P 500, right? In fact, the falling yield here, right? It's been oil, right, has been going down. That's been tracking pretty closely there, except oil, surprisingly today, was up on the day. Yields were down, so you get a subtle break there. Is oil trying to tell us something? We'll see. Let's get back to the 10-year yield and its correlations because, well, what did it do in 2017? Oh, well, okay, so towards the end of the year, going into 2017, it rallied, and then it went lower, and then in September, I mean, we were sitting at the lows. Well, interesting, because right now, what are we doing? Oh, it's September. We rallied into 2025. We went lower. In September, we were sitting at some lows. Almost lows for the year, but we're sitting at some pretty significant lows in the last few trading sessions here. Okay, well, what happened in this time during Trump's presidency in September of 2017? Oh, well, look at that. In the middle of September 17, the 10-year yield actually started to find itself a bottom and rally on from that particular point. Now, I don't know if this is all going to play out the same way. I couldn't tell you that as far as the movement in dollars and yields. But what I can tell you that is if it does move like this and the current correlations are negative, right now correlations change, but the current correlations are negative, that could be a bad sign for the overall markets. What happened to the S&P 500 during this time when Trump was elected in 2017? Well, the market rallied basically all the way through until this blow off top in early 2018. Then we went through some volatility, and then we went through the pandemic. I think it was 2019. Was it 2020, 2019? I'm getting it all confused now. But you can see in September, or going into September, we kind of just went sideways and the market rallied. So, and then if you look at seasonality overall, right now, we typically get some weakness. And then towards the back end of the year, we do typically rally overall. Now, what I find also interesting is this: what moves the dollar and the 10-year yield? Well, typically kind of macro events, right? Macro reports can move them. That's where you could typically get it, or sort of big news shocks, right? Or more talk about tariffs or whatever the case may be. Well, this week we do have, on the 11th, we have inflation data, right? Wednesday, right? We have PPI data. We get consumer sentiment on Friday. Tomorrow we get some non-farm payroll annual revisions. We just got out of the jobs report stuff. Okay, so now we're getting these larger macro reports right at around the same time. So are we going to get a report that comes in hotter than expected for inflation? If so, how is the market going to respond? Because just as we got the jobs report, it indicates things are slowing down, right? And the market started pricing more rate cuts for the year. So if inflation comes in hotter than expected, is that the market just going to reverse that and say, oh, well, inflation's picking up here, and we're going to go ahead and say we're probably not going to do these 3 rate cuts into the end of the year? I don't have that exact answer for you, but that is going to be an interesting, thing that plays out here in the very near future. from what I've seen and some models that I looked at, it does seem as if inflation could come in as an uptick. I don't know how much hotter than expected it is going to come in and how the market's necessarily going to be responding. But what we will do is we'll look at the expected moves and see what the market's pricing in. Because if you get these bigger 2 standard deviation moves, something could be very well shifting big time in these markets. We'll look at the current market conditions because the last couple of videos, right, as the market's been pinned, we've been just finding more and more evidence that, hey, if the market starts slipping from positive gamma, if it starts slipping under its 5-day moving average and it starts declining, a couple of systematic things can really kick into gear where we can see volatility really uptick. And if I look at back month versus front month volatility, we are elevated. We're over 20%. Back month is 20% higher, over 20% higher than front month volatility. And this is where, once again, you get consolidations, pullbacks. We've seen it time and time again. We call it out here. We call it every yellow box you see, we talked about it, okay? Now, if I take a look at the gamma flip line where it's roughly at about 64.20, 64, right in that area, it's more of a zone, right? So we're positive gamma, that's for sure. Positive gamma means dealers are going to suppress volatility by buying the dip and selling the rip, buying the dip, and so forth. Volatility typically suppresses. Okay, but if we start slipping under this, once again, I'm going to keep reiterating, if we start falling under the gamma flip line, we'll probably see some bigger moves in these markets, both from the upside and downside perspective. You can see much more exaggerated moves too, as well, if you're an intraday trader. And that's where I really like kicking my gears, into high gear, or kicking my whatever into high gear, is when we start slipping into that gamma, because you can get some really, really powerful intraday moves for day traders, which we haven't really been seeing here, as the market's kind of just been pinned at this 6,500, which is also an interesting level because it says JPM collar, the short calls, which is 30,000 plus contracts at 64.80. It was originally 64.80. I know that they moved it up. I decided not to move it myself, but I think it's at 65.05. And look, I mean, it stays in this area, right, so far. So as the market moves higher, there's a lot of dynamic hedging that has to take place. And that's what we've been seeing, is the market kind of sells back off, comes back in, sells back off, as traders still continue to reach higher. Now, this JPM collar, it's going to be rolled, obviously, at the end of this month. So it's hard for the market to kind of get higher as it's at these inflection points in the market. So until we start to see some of this maybe gamma roll off and the roll take place, maybe we can get a more clear picture. But as of right now, you're just in this area where it's like, wow, so if selling picks up, you got to be early to it because it can be aggressive and fast, right? If we start breaking up and moving up higher, we might see like little up days, right? And kind of just drags higher, which we've been seeing these last 4 weeks. And then all of a sudden one down day wipes out 30 days of progress of small up days. It's a very interesting kind of dynamic right now. So for me, all I've been doing is kind of taking my foot off the gas. If a setup in a stock looks really good, I'll take it. If it breaks out, awesome. If it breaks down, I'm kind of out of it. And I'm just trying to find my way with various names. I use the tight list and I post the trade ideas, or some of the trade ideas in the Discord group or in the Patreon. So if you want to check that out, make sure to do that. As far as expected moves, because I'm keeping today's video short, the expected moves, I'm going to just share with you what I share with my Patreon group, Discord group, which is the link is in pinned comment if you want to see it. This is what I share with them every day. The daily applied move, these are tiny, by the way. The SPY tomorrow is only $2.85. So the implied move for the day, remember, contraction leads to expansion, and this is a very tiny move. So in the next few days, these are going to expand significantly larger. But you got your upper levels, lower levels, 2 standard deviation moves. These are for tomorrow's trading session. That's Tuesday, right? So maybe we get some chopping on Tuesday before we start getting the bigger reports come Wednesday, come Thursday. Be careful out there. I'll see you on the next video.